Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comment subscribers. I greatly appreciate it. This week up, Facebook. We're going to go through 9 years of financials. We're going to take a look at what they've done. We're going to take a look at where we think they're going to go in the future and how much we can earn by holding the stock long term. You ready to do it? All right, let's do this. All right, let's take a look at Facebook's 10K. Behind me, it was filed in February 2021 for the fiscal year of 2020. It's brand new. I actually reviewed Facebook last year around this time, gave an estimate for the 2020 Ebitda and earnings. We'll see how I did, but let's take a look at Facebook this year and give it an update. But before we do that, let's revisit our 5 key attributes that we look for all of our investments. The first one is top-line revenue growth. Absolutely got to be there. I need Ebitda growth, that's earnings growth. You need strong free cash flow. We need low debt that we measure at less than 3 times debt to Ebitda. And we need a stock that's well priced. It's got to be well priced, maybe not cheap, but fairly valued to give us the economic return that we're going to expect by holding the stock over, in our case, a decade. It could be multiple decades. It could be generational, frankly. All right, I've got revenue behind me for Facebook for the last 9 years. Let's take a look at revenue and Ebitda and see what the business has been doing. All right, so it started in 2012, $5 billion of revenue. That has grown to $86 billion of revenue. That is a lot of jack to produce in a single year. Good for them, good for Facebook. That's a $15 billion delta from 2019 to 2020. That's roughly a 20% move in top-line revenue growth in a single year. When I look over this duration of time, it's averaged around a 42% annual growth rate, obviously distorted because it's super low numbers here, but still strong numbers at a 20% move in a single year of 2019 to 2020. Good for them. Let's take a look at Ebitda. Ebitda, $1.1 billion, has grown to 39, call it 40. Can we say $40 billion of Ebitda? Outstanding growth. That's a strong 13.8% growth rate from 2019 to 2020. Amazing. I actually reviewed Facebook this time last year and underestimated their Ebitda that I thought they were going to produce. So they beat my forecast. Good for them. I'm glad I was conservative. Last time I looked at this, my estimate long-term hold was a 28% annualized return, an absolute monster number. The price is up almost 100% since I reviewed it. Maybe I think it's 60% up when I reviewed it. Let's take a look and see how that affects the current cash flows. The current return, but the cash flow, the earnings are strong in this business. So that's definitely going to check the box. When I look at that on an annualized basis, that's a 55% move in earnings every year. Outstanding. You'll also notice that earnings growth is higher than revenue growth. That means their margins are expanding as they scale, which is something we definitely want to see. Let's take a look at enterprise value, see how that stacks up, see what the whole business is worth. We do that, as you know, we start with debt. Fortunately, Facebook has very little debt, $2.3 billion, which kind of roughly a blip when they first went out, came down to zero very quickly. They borrowed a little bit of debt, but that $11 billion is nothing compared to the $40 billion that they generate annually in earnings. So that's almost a goose egg. Here, strong cash reserves. They're not paying a dividend right now. In fact, they've never paid a dividend. They produce a tremendous amount of cash. They can clearly only invest the cash so quickly, and that cash is stacking up on the balance sheet. Right now, they have $44 billion of cash sitting in the bank, and frankly, that's getting high. I mean, it's no Apple or Google high, but it's definitely way too high in my opinion. They should either kick that out as a dividend, buy back shares, or go do something with the cash that of course is accretive to the business. But holding this money seems a little egregious to me. I'd like to see them do something with it, but nevertheless, it's here. So we're going to subtract this from our enterprise value because really it should have been dividend out. Market cap, shares outstanding times price, that's gone from $60 billion to $785 billion, almost a little over $750 billion. Amazing. Enterprise value, no surprise, has followed that cadence on the back of the market cap expansion, which is driven by earnings growth. Debt on our ratios, right, when we're checking the box, what does the debt piece look like? Well, that's zero because they have so much excess cash. That cash can clearly wipe out the $11 billion that they have. It's like a drop in the bucket. So that's zero. Risk of bankruptcy for us when we do our smell check is almost zero, at least in terms of a debt basis with zero. Enterprise value. So this is our well-priced metric, right? So how many multiples of Ebitda is the enterprise, or how many years of payback can you expect the company to generate to buy itself back? And you can see early on at 45 times, it's clearly a strong premium for the business. But had you bought it back then, it panned out very nicely. The cash flows that have produced have clearly bought that business and paid for itself. And just take a look at this. The market cap was $53 billion. If I look at the EBITDA that was actually generated on a forward basis, actual history, what happened, it would have taken here $57 billion. So if I sum these EBITDAs, 1, 2, 3, 4, 5, 6 years out, this cash flow is $57 billion, which is the enterprise value you would have paid back in the day. So when you bought it at an original 45 multiple. But in reality, because growth was so quick, it only took them 6 years to pay back. Outstanding. Now the question is, they're now $750 billion in market cap. They're making $40 billion a year in EBITDA. They're trading at 19 times earnings. So now you buy it, assuming no growth, you need to wait 19 years to pay back. So they still need to grow to make that a little smaller, but that is not at all an unreasonable price to pay for a company that's growing revenue double digit, strong cash flow, strong earnings that are growing double digit, and no debt. So this is still, in my opinion, a very reasonable, if not cheap, multiple for this type of company. All right, let's take a look at cash flow. My favorite number, right? So picking up 2012 cash flow from operations, CFO, the first third of the cash flow statement, down to 2020. They started at $1.6 billion. It's grown to $38.7 billion of cash flow. That's a 50% annualized growth rate. That lines up beautifully with the EBITDA growth rate. So that means that the accounting team, the finance guys, are taking the P&L, and the financial statement is the P&L and the financial statement is reflecting cash appropriately. There's no funny business going on. I like that. CapEx is the money they have to put back in the business to keep the machine rolling. That is relatively low when compared to the cash that they generate. It's definitely grown $1 billion to $15 billion as they've scaled, but so has free cash flow. So at the end of the year, they generated $38 billion of cash that's sitting in their bank account. They peel off $15 billion to put back in the business, and they have this delta left. That's roughly $23 billion because they have no debt. This is what is Facebook is valued on. It's this cash flow that you're buying as an investor. When you take the shares, you divide the cash flow by the shares, you get cash flow per share. And last year, they generated $8.10 of free cash flow per share for every share you owned. Now, one thing I think is interesting is they don't appear to be buying back any shares. And I would like to see them do that. They've got a ton of cash piling up on the balance sheet, and they're not buying back any shares. I mean, this is a really small move annually. I'd like to see them do that a little bit more, make use of some of the money. Certainly, their stock, in my opinion, is underpriced when you consider some of the other internet companies and what they're trading at. Facebook should be buying back their shares. They're not prudently using their cash. Strong ROIC, right? Strong 20s range. Coming down a little bit as they have size, but it's still anything north of 20%, in my opinion, is a great return on invested capital metric. And over the long term, the return on a stock tends to mirror this number. So if you've got a good decade of a company with a return on invested capital at above 20%, you should expect the stock price, all things being equal, to return about the same percentage of that. Cash flow yield, so I take cash flow, divide by price, right? You get a yield. It's in the average 2.9% in the high twos. but strong free cash flow. Okay, let's forecast Ebitda. Let's forecast free cash flow. We'll come up with what we think the price is for Facebook under two different methods. Then we'll average the two and figure out what the economic return is. All right, so let's pick up the Ebitda. So we've got $44 billion is our forecasted 2021 Ebitda for Facebook. That's a 12% growth rate on the last year's number of 2020. I then grow it at 12% for a little while, and I start bringing it down over time as they continue to scale. I want some conservatism here. That puts a long-term forecast Ebitda of $95 billion, and that's actually considerably higher than the number I had in my last forecast, mainly because the forecast Ebitda that I had was just a little lower. They've outperformed, which has been amazing. So $95 billion long-term forecast. I'm giving it a 20 times Ebitda handle, a slight market multiple expansion from where they are. They definitely deserve it. Less debt plus cash gives me a market cap $2 trillion out a decade from now. Divide by shares outstanding gives me a $700 price target. If I put into the free cash flow method, so I've got $9 roughly as a free cash flow target next year. I'm growing at the same growth rate because they have very little debt, so they don't have anything to pay off. Ebitda should translate to free cash flow. And I get just shy of $20 of free cash flow per share out in 10 years. If I play a free cash flow yield of 2.5% of that cash, and I get a price target of $778 long term. All right, now we have two price targets, one on the free cash flow method, one on the Ebitda market multiple. I'm going to take a 50-50 split because who knows what it's going to be. And I get roughly $750 is my long-term price target for Facebook. If I look at the current price is $270. And then if we put this into an IRR calculation, you get a stream of cash flow that they're going to generate over time. You buy the cash flow at $270. You sell it a decade from now at $741, and you get this kind of net cash flow, if you will. If I put an IRR against that, it's a 16% return, which is a very it's a strong return. It's above market, but it's not 28% that I had previously, mainly because the price itself has gone up a lot. I've also moved the forecast north. When I looked at the Ebitda number that I had, I actually missed an add back of $5 billion for a legal settlement that Facebook paid. When I read the disclosures, I didn't see it. Now that I'm looking back at it with new data, it's clearly there. So I've upped my historical Ebitda, which has moved the entire forecast up a little bit. That's if you go back and see the video, that's what you're going to see. But that has more than chewed up. The increased Ebitda that I have now has been more than chewed up with the higher price that you're going to pay for the stock currently, and that's lowering the return from the last time we looked at this. But it's still a healthy return, primarily because I think the market multiple of the stock is still a whole lot lower than the rest of the market. The free cash flow is strong, and really it deserves a little bit more attention. So I think it's a strong return at 16%. I'd also like to see Facebook start paying a dividend. And if they use some of that cash to start paying a dividend or buying back their shares, you should see the stock price move higher as a result of that. So what are we going to give this? I'm going to give this a good, absolutely. I still own the stock. I've owned it for years. I continue to like it. It's certainly well priced. If I give you a distribution curve here, you can see $270, 16%. If it was back down to where we were looking at it, it was actually $160 when I was reviewing it this time last year. It was a monster return. Thank you, I bought it at that point. Kudos to me. So $270, 16%, still a good stock. I'm not selling it. And if it goes up to $360, it's a 12% long-term play. Nice little company. All right, let's review our 5 key factors for Facebook just to check it out. Top line revenue growth, absolutely. Earnings growth, massive. Free cash flow, extremely strong. Low debt, 0. And well priced, absolutely. I think this one checks all the boxes. And what I particularly like about it is that the growth rate of earnings and cash flow are strong. We've looked at other stocks in this channel, such as the big dividend players, that pay a strong dividend, can check all the boxes, but the growth really isn't there. And if I'm going to buy something that does check all the boxes, I still want it to be able to grow and have really strong long-term prospects. So that's why I like Facebook and some of these other stocks that we've looked at this channel. All right, let me know what you think of this stock. I'd love to hear the comments. What else would you like me to review? I'm happy to take a look at it. My name is Cameron Stewart, CFA. This has been Rational Investing. Thank you very much for watching the channel and giving me all the support. I greatly appreciate it. Take care. Bye-bye.